There's a certain mystique that surrounds private equity. It's often portrayed as this exclusive realm, a black box where unimaginable returns are conjured by titans of finance, accessible only to a privileged few. For the ambitious investor, the one driven by a hunger for financial mastery and a desire to build something truly sustainable, this allure can be powerful. But what truly lies beneath that polished surface? Is it always the effortless accumulation of wealth that the brochures and headlines suggest? The mainstream narrative is compelling, isn't it? It speaks of lucrative deals, of companies transformed, of astronomical gains. But for those of us who are intellectually curious, who value data over dogma, and who possess a healthy skepticism towards conventional wisdom, we know that the true story is rarely so simple. Private equity is far more than just a series of deals. It's a complex, intricate ecosystem, brimming with both profound opportunities and inherent, often overlooked risks. It demands a critical, data-driven lens, a willingness to dissect the mechanics rather than simply accept the marketing. Our mission here is clear: to move beyond the hype. We are here to dissect the hidden truths of private equity. These are the insights that truly separate a superficial understanding from genuine, actionable investor intelligence. We aim to equip you, the critical investor, with the knowledge to navigate this sophisticated asset class with confidence and clarity. As Benjamin Graham, the father of value investing, so wisely advised in the intelligent investor *, the investor's primary task is not to select the best securities, but to make the best decisions for himself. We will apply this fundamental principle to the world of private equity. It's not about finding the best pay fund by name alone, but about making the best decisions for *U* based on a deep, critical evaluation of what lies within. This requires understanding the operational realities, the often intricate fee structures, and the long-term implications that can profoundly shape your wealth accumulation journey. This guide is for those who are ready to peel back the layers, to understand the engine under the hood, and to make decisions rooted in truth, not just in aspiration. Let's begin with our first hidden truth, a cornerstone in understanding private equity. The liquidity premium is often a symptom, not a strategy. We hear this term frequently, that because your capital is locked away for an extended period in private equity, you are inherently compensated with higher returns. It's presented as a kind of guaranteed reward for your patience, a passive bonus for tying up your funds. But is that truly the case? While it's undeniable that private equity capital is committed for years, the notion that this illiquidity itself is the primary driver of superior returns is a narrative that warrants deep scrutiny. The real engine of value generation in private equity doesn't come from the mere passage of time or from simply holding an asset. It comes from active, hands-on management, from genuine operational improvements, from strategic leverage and repositioning. Consider this analogy. Think of a finely tuned engine. The engine itself, representing the private equity firm's expertise in identifying opportunities, transforming businesses, and executing a clear strategy, is what drives the vehicle's performance. It's not merely the fact that the car is parked in a garage for an extended period. The car doesn't magically become faster or more efficient just by sitting idle. This is where the hidden risk lies for the unwary investor. Many pay a premium, assuming illiquidity automatically translates to higher returns. They overlook the crucial fact that poorly executed operational changes, or worse, excessive leverage that strains the business, can completely erode any benefit from that illiquidity. We will delve into situations where this supposed premium vanished because the underlying strategy was flawed. So, what's the actionable insight here for you, the critical investor? It's to rigorously scrutinize the private equity firm's track record, not just in raising capital, but specifically in operational value creation and successful exits *. Look at their performance across various market conditions. Understand the fund's expected holding period and, critically, their detailed exit strategy. This truth reveals that the perceived premium is a direct function of skill, insight, and diligent execution. It is not an inherent, passive reward for tying up your capital. It demands from you rigorous due diligence on the of value creation. Now, let's pull back the curtain on another critical aspect of private equity, one that often leaves investors scratching their heads. Truth number 2. Fee structures are a complex web, meticulously designed to maximize the general partner's take. We're all familiar with the standard 2 and 20, a 2% management fee and a 20% performance fee, often called carried interest. But this, my friends, is merely the tip of the iceberg. Beneath its surface lies a labyrinth of other charges. There are waterfall distributions, which dictate how profits are divided, often with intricate clauses that favor the GP. Then come transaction fees, monitoring fees, organizational expenses, and a host of other costs that can significantly diminish the returns you, the limited partner, actually receive. Imagine you're building a house. The advertised price might seem manageable, even attractive, but there Then, as the construction progresses, come the extras, the plumbing fees, the electrical fees, the landscaping fees, the inspection fees. Suddenly, that initial price ballooning into something far greater. Private equity fee structures can operate with a similar, often opaque, mechanism. This complexity can obscure a fundamental tension. While general partners often speak of alignment with their limited partners, the intricate fee structures can, in practice, incentivize behaviors that aren't always in the LP's best interest. A GP might be incentivized to pursue larger deals, to employ higher leverage, or to see quicker, less optimal exits, not necessarily for the absolute best long-term outcome for the LPS, but to maximize their own fees and carried interest. Therefore, the actionable insight is clear. Demand absolute transparency on all fees and expenses. Don't just accept the headline figures. You must be prepared to model the true net returns under various performance scenarios. Understand the catch-up clauses, how they work, and how they impact your actual profit share. Critically, compare these projected net of fee returns with public market benchmarks. This truth underscores the vital need for sophisticated financial modeling and a deeply skeptical eye towards fee disclosures, ensuring your hard-earned returns aren't significantly eroded before they even reach your pocket. Let us turn our attention to the third hidden truth in private equity. The control advantage is often overstated or, more critically, misapplied. Pay firms frequently tout their ability to take significant stakes, even full control, as a primary reason for their superior performance. They argue this control allows them to make swift, strategic decisions and implement crucial operational improvements that public companies, often constrained by dispersed ownership and stakeholder pressures, simply cannot. However, the reality on the ground is far more nuanced. True control isn't always absolute, and the ability to leverage that control effectively is not guaranteed. Many pay deals involve significant minority stakes, or the pay firm might be managing such a large portfolio that their capacity to exert meaningful, hands-on operational influence across every single company is stretched thin. This brings us to a core concept in economics, the principal-agent problem. Even when a pay firm holds a controlling stake, a misalignment of interests can persist. The agents, the pay managers, might, consciously or unconsciously, prioritize their own interests, such as maximizing management fees or securing a quick, profitable exit, over the long-term wealth creation goals of the principals, the investors. The theoretical advantage of control doesn't automatically translate into superior outcomes for those whose capital is at risk. Here lies a hidden downside. When pay firms become overextended, taking on too many portfolio companies, their ability to truly drive change diminishes. They can fall into a cookie-cutter approach, applying generic strategies that fail to unlock the unique potential of each individual business. The supposed advantage of control becomes diluted, ineffective. So, what is your actionable insight? It lies in investigating the pay firm's deal sourcing strategy and their portfolio construction. Do they focus on a select few high-conviction investments where they possess the genuine expertise and resources to add substantial value? Or are they spread too thin, like a painter trying to cover too large a canvas with too little paint? Examine their operational team's size and expertise relative to the number and complexity of the companies they manage. This truth compels us to critically assess the control premium and determine if the pay firm's actual capabilities and available resources truly justify the premium they charge, distinguishing between theoretical control and practical, value-adding oversight. We now arrive at the fourth, and perhaps most critical, hidden truth within the realm of private equity. Exit strategies are the most critical, yet least transparent, part of the entire equation. The entire success of a private equity investment, from its inception to its conclusion, hinges almost entirely on the exit. Whether it's an initial public offering, a strategic trade sale to another company, or a secondary buyout where the company is sold to another pay firm, the endgame is what determines whether the investment was a triumph or a disappointment. Yet, the planning and execution of these crucial exits are frequently shrouded in an opacity that leaves limited partners, the investors providing the capital, in the dark. It's like planning a complex, ambitious expedition. The journey itself, the period of investment and operational improvement, is undoubtedly important, but the ultimate success of that expedition is judged solely by reaching the intended destination and doing so profitably and safely. If the strategy for that destination is unclear, or if it's fundamentally flawed, the entire endeavor, no matter how well managed the journey, is inherently at risk. This brings us to a significant risk, the peril of forced exits. Private equity firms may find themselves pressured to exit investments prematurely. This pressure can stem from the finite life cycle of their funds, which often have a defined term, or from investor demand for liquidity. Such circumstances can unfortunately lead to suboptimal valuations, as the firm might prioritize exiting within a deadline over waiting for the ideal market conditions for a higher price. We we will examine instances where market timing, rather than strategic perfection, dictated the exit prices achieved. Therefore, your actionable insight here is to deeply question the pay firm's exit track record across a variety of market cycles. Don't just look at their overall returns. Dissect how they've performed during both bull and bear markets. Understand their typical holding periods and, crucially, the underlying rationale behind them. Inquire about their established relationships with investment banks and potential strategic acquirers. This truth emphasizes with unwavering clarity that a private equity investment is not truly complete until the exit is successfully realized. It underscores the profound importance of understanding the endgame from day one, not as a mere afterthought. We arrive now at our fifth and final hidden truth, one that truly separates the informed investor from the casual observer in the world of private equity. Regulatory arbitrage and economic moats are private equity's true secret weapons. While we've discussed operational improvements and strategic control, the more sophisticated and often less visible drivers of pay returns lie in their ability to expertly navigate complex regulatory landscapes and to identify, build, or acquire companies possessing robust economic moats. Think about it. Pay firms often leverage regulatory loopholes, exploit tax advantages, and harness their unique position to build or acquire businesses that have powerful, defensible economic moats, those durable competitive advantages that protect profitability. These factors, often operating behind the scenes, contribute significantly to the enhanced returns that pay aims to deliver. This relates to fundamental economic concepts like information asymmetry and regulatory capture. Private equity firms, by their very nature, often possess superior information and a specialized expertise in navigating intricate regulatory and tax environments. This allows them to create an advantage, a distinct edge, that the average retail investor simply cannot replicate. They speak a language of compliance and financial engineering that is often foreign to those outside the industry. This can challenge the notion of democratization in finance. While it's true that some private equity products are becoming more accessible, the core advantages, deep industry knowledge, privileged access to proprietary deal flow, and sophisticated financial engineering capabilities remain largely exclusive to institutional and high net worth investors. So, what is your actionable insight as an ambitious investor seeking to understand this space? It requires shifting your focus from just the operational narrative to understanding the underlying economic moats of the target companies within a pay fund's portfolio. You must research the fund's strategy concerning the regulatory environments in which they operate and their approach to tax optimization. Critically, you need to understand how these structural factors contribute to the projected returns. This final truth reveals that sustainable outperformance in private equity is frequently built on a foundation of strategic, often opaque, advantages that require a truly critical, informed perspective to discern. We've journeyed through the often opaque world of private equity, dissecting 5 hidden truths that are crucial for any critical investor. We've peeled back the layers on the so-called illiquidity premium, revealing it as a symptom of skillful execution rather than an inherent reward. We've navigated the complex web of fee structures, understanding how they are meticulously designed, and the vital importance of demanding transparency. We've examined the nuanced reality of the control advantage, questioning its true impact beyond the theoretical. We've underscored the paramount importance of exit strategies, recognizing them as the ultimate determinant of success and often the least transparent element. And finally, we've uncovered how regulatory arbitrage and economic moats serve as pay's true secret weapons, often providing structural advantages that demand a sophisticated understanding. The overarching takeaway from this exploration is clear. Private equity can indeed be a powerful engine for wealth creation. However, it is a tool best wielded by those who approach it with a critical, data-driven mindset. It requires actively seeking to understand the intricate mechanisms that drive returns, looking beyond the glossy marketing and the alluring headlines. This is where Benjamin Graham's timeless wisdom on the margin of safety finds its profound application, extending far beyond just the valuation of publicly traded stocks. For the private equity investor, this margin of safety is built through relentless questioning, through deep dives into fund operations, fee structures, and exit plans. It is the buffer of knowledge and rigorous due diligence you construct around your investment decisions. Armed with this deeper understanding, you are now better equipped to engage with private equity opportunities. You can ask the right questions, probe the assumptions, and make more informed decisions that are genuinely aligned with your pursuit of sustainable, long-term wealth. The financial world is a vast landscape, filled with complex instruments and strategies. Continuing to hone your analytical skills, to maintain that healthy skepticism, and to seek out the genuine mechanics beneath the surface is your greatest asset. As we conclude this discussion, a question lingers. What other complex markets or sophisticated strategies would you like us to dissect next? Where shall our critical inquiry lead us in the ongoing quest for financial mastery?